Hello, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI Premium Member Only webinar titled Covered Call Writing, a Streamlined Approach. How to consistently beat the market using the CEO strategy, which is an acronym for combining exchange-traded funds with stock options. I'm here today with Barry Bergman, BCI Managing Director. Barry's in the background, and if you have any questions while I'm going through this PowerPoint presentation, you could feel free to type them in the chat box, and Barry will respond. Also, at the end of the presentation, if there are any questions that you've sent to Barry or hasn't had a chance to get to at that point in time, I'll be happy to stay on as long as you need me to respond to these questions. I also want to thank all of you who have been waiting patiently for this presentation to get started. Now, let me give you a little bit of a background as to how this particular approach to covered call writing got started. As many of you know, BCI has been now in existence for 16 years, and I've had an opportunity to have dialogue with either in person or or via emails, phones, this and that, of thousands and thousands of members from all over the world who have given me feedback regarding what they're looking for in their option selling strategies. And that has resulted, as many of you know, in BCI presenting many different ways to craft our covered call writing and put selling strategies. And we have presented many of them in the past. And tonight I'm presenting to you, our premium members, another approach to covered call writing. So it's quite humbling, and I consider my good fortune to having had this dialogue with so many of you over so many years. And I always thought, and I always kind of felt like I was satisfied that I had thousands, maybe even tens of thousands, that I had an opportunity to impact in some small way in their investment lives. And I was satisfied with that. It made me happy. I felt like, gee, I've accomplished a goal that has made me and my team feel like we are doing something positive. But then one day it hit me. Is there a way that I can change thousands to millions? Is it possible? And that would involve a strategy that would be a little more user-friendly, a little more time efficient, because many of us have challenges in our lives in terms of our working, in terms of families, in terms of hobbies. And so over 3 years ago, I started by trial and error to create an approach to covered call writing that would meet the needs of those that fell into these categories. Now, the reason it took me 3 years is because frequently, in order to get something done that actually works and that's actually positive, you have to make mistakes. You have to do things that you thought would work, turns out it didn't, and then you kind of look for another way to approach it, and ultimately you'll come up with something that would click. And for me, that clicked in the third year of this, the calendar year 2022. And that is what the book that I'm about to show you is all about. All the trading I did for the entire calendar year 2022 using this particular approach. So what is the CEO strategy? Well, it is, as the title of this presentation, a streamlined approach to covered call writing. Many of you know that the number of stocks and ETFs out there in US exchanges is well over 8,000. We're going to reduce that number to 11. Now, the exit strategy arsenal that I published in my last book, which I'll also be showing you at the end of this presentation, for covered call writing, there are 14 different exit strategy opportunities. We're going to streamline that down to 4. And so we're going to create opportunities to beat the market on a consistent basis using this unique, user-friendly, and time-efficient style. Once again, CEO is an acronym for combining exchange-traded funds with stock options. So let's first start. I know many of you know this already, but some may not. So let's just give a definition of what is an exchange-traded fund and why did I choose to use these. Well, these are securities that are baskets of stocks. So when you own one share of an ETF, you own pieces of many, many different stocks. So that adds to our diversification requirement. By owning an ETF, we are automatically fairly diversified. Now, these ETFs can track an index, a commodity, an industry, or a basket of assets, like an index fund. Now they trade like a stock, not like a mutual fund, because they experience price changes throughout the day. And they also allow us to utilize less underlying securities because of our diversification requirement. So that's the reason why I chose exchange-traded funds for this CEO strategy. Now, in particular, we're going to be using the select sector spiders, which are special types of ETFs. They're unique in that they divide the S&P 500. Now, when people talk about the market in quotes, they're talking about the S&P 500, not the Dow 30. So these select sector spiders divide the S&P 500 into 11 funds that focus in on a specific industry or sector. Now, if we own the top 4, let's say, select sector spiders, then we own approximately the top 35% of the S&P 500 in terms of price performance at that point in time. If we own 5, we own the top 46%. And in my book, we will use either 4 or 5 of these each contract monthly cycle. Now they have the diversity of a mutual fund, so you can consider the select sector spiders like mutual funds, except they trade like a stock. So you can buy and sell them during the course of the day. And all 11 of them have options associated with them. And they all have fairly good option liquidity. So they are great candidates for this streamlined approach to covered call writing. As I said, if you take all 11 and put them all together, what do you have? You have the S&P 500. And once again, you could use them with covered call writing because they all do have options associated with them. Now, here's a list of the 11 select sector spiders. Now, just to give you an example, in the last month, as you know, the market's been struggling with interest rate and inflation data, and recently the collapse of that bank. So the market in the last month is down well over 5%. But if you look through the price performance of the select sector spiders, you would find that XLU, utilities, XLP, and XLI industrials have outperformed the S&P 500 by about 2 to 4%. So if we were to enter in a particular contract, this upcoming contract, at this point in time, it's not the beginning of a contract, but if it was, we would be favoring those select sector spiders that have been outperforming in the last 1 month. And that's what the basis of the CEO strategy is, as you'll find out when you read the book. Now, back to my 8th book, which I published last year, Exit Strategies for Covered Call Writing and Selling Cash Secured Puts, you will see these 14 potential covered call writing exit strategy opportunities. But for the CEO strategy, we're going to focus like a laser on 4 of them. The 4 that you would use most often, the 4 that would give you the greatest protection in a down market, and therefore the 4 that will have the greatest impact on our portfolios, given the fact that we are looking for a streamlined approach to covered call writing. So CEO strategy is specific for those of us that want to use covered call writing, want an opportunity to beat the market on a consistent basis, and yet to do it in a time-efficient, user-friendly way. It's not for everybody, but if you fit into one of those categories, this may be a great approach for you relating to covered call writing. So what are our strategy goals in real life trading? You'll see, I don't know if there's ever been a book written like the one I just published that will be available tonight in PDF format and in a couple of weeks as a standalone product. But you will see not only every trade that I made, but you will see the reason why I made the trade, the reason why I made any trade adjustments, my initial and final returns, and a screenshot taken from my brokerage account of every single trade and adjustment that I made over the course of the calendar year 2022 regarding the monthly contract expiration. So it actually starts in the latter part of December 2021 when the December 21 contracts expired. That's when I started, and it ended at the expiration of the December 22 contracts. So the third Friday in December of 22 is when it ended. So what is our goal? Well, to create a user-friendly and time-efficient approach to covered call writing. And we want to beat the market on a consistent basis, at least give ourselves that opportunity to beat the market most of the time. There will be times when we won't beat the market, particularly if we have a raging bull market. When we use covered call writing, we're capping the upside, and so we may not beat the market. We'll still do really well, but we may not beat the market. So the reason that we are giving ourselves the opportunity to beat the market on a consistent basis relates to just the definition of covered call writing, is that we are lowering our cost basis. Now, my expectation when I started this project 3 years ago was to have this streamlined approach that would beat the market. And based on my 25 years of using covered call writing, I felt like that we should beat the market somewhere between 8 and 10% a year. As it turns out, if you turn to the last chapter of my book, we actually beat the market by more than 15%. Now, I'm not saying we're going to do that all the time. You know, I think some years are going to be closer to that 8 to 10% range, maybe a little bit more, but we should beat the market consistently unless we're in a raging bull market. That would be the exception, what I would not expect to beat the overall market. We want to compare the CEO portfolios to the market returns, the returns of the S&P 500. Because look, let's face it, folks, if we're just going to do what the market's doing, right, then we might as well just buy a broad market, low expense ratio mutual fund, dollar cost average into it, an index fund, and we don't have to bother with covered call writing or reevaluating our portfolios on a monthly basis, et cetera. We are doing this because we are looking to beat the market. Now, another expectation I had going in, and this was almost a no-brainer, is we want to reduce the volatility in our portfolios. And that, folks, is almost the definition of covered call writing. By lowering our cost basis, we are automatically reducing portfolio volatility. So that I was one of my expectations. It was almost like, I know this is going to happen, and it certainly did. Now, what's the trade-off? Every strategy, and I've been telling the BCI community this for years, every strategy has pros and cons to it. And I never portray any strategy as a panacea, that it's all good. There's no risk. I never, ever do that. And here is the trade-off with the CEO strategy compared to all the other strategy approaches to covered call writing and selling cash secured puts that you've learned here at BCI, maybe other places as well, is that we're going to end up with lower return opportunities than traditional covered call writing. That is the trade-off. Because first of all, when you're using ETFs, and especially the select sector spiders, They have less implied volatility than individual stocks. This is a generalization now. Of course, there are exceptions to that. So because we're using lower implied volatility securities, the premiums are going to be lower. And because we're using fewer of the exit strategy opportunities, we're also going to be losing a little bit there. But if we could still beat the market significantly most of the time, then this may in fact be a strategy for you. So let's talk now about the advantages of this CEO strategy. What I've learned in the last year of trading it, that's archived in the book, is that we wanted to have a strategy that's user-friendly and time efficient, and it is. Because the pool of underlying securities is reduced, as I said, from over 8,000 to 11. Exit strategies reduced from 14 to 4. And Barry and I have created spreadsheets that will facilitate portfolio construction and calculations, as well as comparisons of the CEO portfolios to the overall market. And I'll be showing you those spreadsheets very shortly. Now, what about our monthly and annualized returns? Well, in most market conditions, this strategy approach will give us the opportunity to beat the market on a consistent basis, and much of the time significantly. You can say that about traditional covered call writing as well, although for the CEO strategy, your expectation should be that you're going to beat the market by a lesser amount than traditional covered call writing, but you will be doing it in a more user-friendly, time-efficient way. Is that right for you? Are you better off with traditional versus CEO? Only you could make that personal decision. But what I wanted to do was to provide those members who actually fall into these categories an opportunity to participate and still beat the market, or have the opportunity to beat the market. And then if things change and you have a little more time and you master the strategies a little bit more, then you could move on to traditional. Now, portfolio volatility I alluded to before, and yes, you will experience less portfolio volatility. If you do the strategy right, I could say that with as close to 100% confidence as I can. So who would benefit? Well, I see this as a strategy appealing to those who work long hours. I hear from you, I have a job, I work late at night, or I have 2 jobs, I'm raising 3 kids, or I'm still in school and I'm studying for finals. This might be a strategy if you fall into one of these categories. What about if you're retired and you have all these hobbies that you're enjoying, family activities, and you say, gee, I want to do this, but I want to dedicate less time than traditional. Well, this might be a strategy for you. As I said in this third bullet point here, folks, there is no single strategy that's right for every single investor. The last 3 years, I worked on a blueprint that will benefit those who want to become financially independent. And as I always say, CEOs of our own money, while still aligning with challenging personal, family, and work schedules. That was the goal that I set out when I started to work on this 3 years ago. Where can you get more information on this? Well, it's up now live. Some of you actually already found it and made purchases of the CEO product. You can go to our website and click on the best discounted packages link or the store link, and here's what you're going to see. So those of you familiar with this, you know about the BCI package. I'll mention it in a moment. The TMC Trade Management Calculator package. And here we go. We squeezed in all the way to the right, the CEO package. So let me tell you the components of it, because there's three prongs of the CEO package that you can purchase. The enhanced CEO package is the one we felt would apply to most of you, and I'm going to be showing you the spreadsheets, how they work, and we'll put a little more time into this to give you an idea of what we have. It consists of these 6 components. The book, Covered Call Writing, a Streamlined Approach. You've probably seen a screenshot of the cover. I've been showing it for the last month or so in PDF format. I recently received the first several hundred copies of the physical book, but we don't have enough yet. We needed several hundred more before I make it available as a standalone product. In the next few weeks, it will be available as a physical book once we receive several hundred more copies, and I have enough to fulfill the initial trades. But right now, you'll get the PDF version of that book, which contains screenshots, and I'll show you a few of these as we move along tonight, of every trade and adjustment I made over an entire year. It also includes the book, my last book that I published, Exit Strategies for Covered Call Writing and Selling Cash Secured Puts, also the PDF version. So you could study the exit strategy opportunities relating to the CEO strategy. Now, the two new spreadsheets you see here in the third and fourth bullets, I'll show you those in a moment. The portfolio setup spreadsheets, which is really going to make it easy for you to set up your monthly or weekly, if you choose weeklies, I use monthlies, portfolios, which will address diversification and having enough cash reserve for exit strategies. And then the CEO results spreadsheet, which will give you every month your final results, year to date, and also compared to that of the S&P 500. So you know how you're doing compared to the overall market. It will also include our trade management calculator, or TMC, and its user guide. Now, I know that many of you already have the TMC package, which is the exit strategy book, the calculator, and its user guide. So there is going to be an opportunity for you to get the CEO package without that. We've thought that through. So here is a screenshot of the book. And if you notice, what I did for you folks is I highlighted in brown the 12 contract months for the year 2022. In each of these chapters, you're going to see screenshots of every single trade that I made and every trade adjustments, the reason why I entered the trade, the reason why I made the adjustment, and then you'll see the outcomes. Now, this is an example of one of the screenshots taken from the book. And here you see 7 contracts of XLF were sold at 61 cents. And then you could see that I set a 20% buy to close limit order using the 20% guidelines at 12 cents. So you should always have your 20%, 10% guidelines in place, whether you're using CEO strategy or just traditional covered call writing. And you see the same thing down here for XLP, sold 3 contracts at 90 cents. What's 20% of that? 18 cents. So you can see here, this is an example of the screenshots. And by the way, there are 199 color images in this book. It has, in my encyclopedia, the classic edition, there were 150 something. This book has 199 because I took a screenshot of every trade I made over the course of the year 2022. And I'll also show you screenshots taken of this portfolio, which I funded with $100,000 at the end of each contract. So here, for example, you see that at the end of this month, I had 101,468, and I had these 2 securities left. The others were exercised and sold, and I had this amount of cash here at the bottom. So you could just take a look and say, okay, this is what Alan had at the end of that particular contract cycle. Now here's I'm going to show you the 2 new spreadsheets now. This is the portfolio setup spreadsheet. We make it really, really easy for you to set up and craft your portfolio. You could see here at the top in the number 1 area, it doesn't say number 1 on the spreadsheet, but this is for the purposes of the slide, so I can allude to it. We're talking about the December, the year 2022, the expiration date 12/16/22, and days to expiration 4. So this was just a screenshot of that I took right towards the end of that December 22 contract. And you could see that it shows the cash available 92,583.46, and I was going to use 4 securities for the upcoming contract. So this will automatically tell me in these yellow cells here the range of cash available that I'll need for potential exit strategy opportunities. Now, section 2 is just instructions on the spreadsheet. Okay, now let's move to section 3, which is the initial setup. Could also be the final setup, but we'll make it the initial setup and see how that works out. Here's what the spreadsheet will do for us. You have to fill in the blue cells the 4 securities. These are select sector spiders that were outperforming in the last month at that point in time. The spreadsheet will tell us, based on 92,583.46 and 4 securities, that each position we're going to allocate 23,145.87 to. We fill in the price per share at the time we're crafting our portfolios, and the spreadsheet will do the rest of the work for us. Let's look at XLP, for example. At the time it was trading at 72.94, and we're allocating 23,145.87. That means the spreadsheet will tell us we can purchase 317 shares. Well, if we're selling options, we only can sell them in 100 share increments. The spreadsheet will automatically round that down to 300, meaning that initially we're going to sell 3 contracts, and it will calculate the cost of the shares if we purchased 300 shares. Now, if we look at XLRE as an example, that came to, it was $41 a share, same amount we're allocating, 565 shares. The spreadsheet will automatically round that up. So depending on if it's above or below the 50 number. In this case, it was above 550, so it's rounded up. That means 6 contracts, which would cost 24,600. Now remember, we're just on the initial setup here. Now, if we go down to the bottom and we did this initial setup, we would be spending more money than we have, over 93,000, and it will show you in red that there's a loss, or we're missing $866. What do? We go over to the final setup section. Now notice here we have 3632. We have to change one of those to a lower number. Since 565 was rounded up, and it's kind of close to the midpoint, why don't we round it down to 500? So instead we have 3532. In that case, we're spending $89,350, and we have a cash reserve of $3,200. So if the initial setup spreadsheet fell into this range, we wouldn't have to do any adjustment. But whenever it does, we just move over to the right side of the spreadsheet, adjust 100 shares, sometimes it has to be 200 shares, and boom, then you will have your portfolio set up for the following Monday. This is done on the weekend after contract expiration. Now, the other spreadsheet that I want to show you is the CEO results spreadsheet. And you could see here that when we started on December 19th, 21, after expiration of the December 21 contracts, at that time, the S&P was trading at 46.21, and I funded this account with $100,000. So each month, what we did was we put in the blue cells the date after the contract expired, the value of the S&P 500 at that point in time. So you could see here after the first month, after January 22 contracts expired, the S&P dropped from 46.21 to 43.98. All you have to do is put in the date and the amount at the price of the S&P at that point in time. And then you put in what your portfolio value was worth. I showed you a screenshot before when it was worth this 101. So here it was worth 99,615. The spreadsheet will then show us the following, folks. The S&P 500 year to date was down 4.83%. The CEO portfolio was down 0.38%. The difference was the CEO portfolio was outperforming after the first month, outperforming the S&P by 4.44%. And you could follow this along every month. In my book, I show you this spreadsheet every single month and until the end of the December contracts 2022. So you can get an idea of how you're doing and how this is progressing over the course of the calendar year. Now, Barry combined both spreadsheets so that whichever spreadsheet you're using, you can access the other one simply by clicking the tab at the bottom of the spreadsheet where you see the red arrows. So you could just have the one spreadsheet on your desktop, that's what I have, and then you can access both of them just by deciding which tab you want to use at that point in time. Now, what I do is I save, just like the TMC calculator, I save the spreadsheet. So save as, put the date on it, and then you go to a blank one to start the next month if you want to actually save them for each month. Otherwise, you could just run a running total for your comparison with the S&P 500. Now, the exit strategy book I told you about is part of the enhanced CEO package. It contains 27 chapters, and here are the 14 exit strategies for covered call writing, for traditional covered call writing, but for the CEO strategy, we're only going to select 4 of them. Now, here's a screenshot which is taken from the book of the trade management calculator, where we're looking to see if we're meeting our strategy goals, initial time value return goals, which is 1 to 2%. I specify this in the book. That's what our goal is, 1 to 2% a month. And we're going to stick with out of the money calls, which will give us an opportunity for upside potential as well. So here are the 4 securities for the first month. The trade entry date, 12/19, and the expiration date was the 3rd Friday in January 22. Here were the prices of the stocks you see here, and the strike prices, slightly out of the money strikes I used in this strategy, and the option premiums, and the number of shares, remember 3532. And now if we go to the brown cells, you'll see that the initial returns did in fact meet our 1 to 2% goal. I mean, these are guidelines, folks, guidelines. So if it's a little less or a little more, sometimes in the book I went almost up to 3%. But you know, these are guidelines. It should be in that range. So our portfolios, if you took an average, should have initial time value return goals of 1 to 2%. A little bit more is okay. Now, if you look at the purple cells, that gives you the upside potential if the price of the security moves from current market value. Let's look at XLV, for example, 137.93, up to the out of the money strike 139, and that would be an additional 0.78%. So you have a 1.65 and almost another, so about a 2.5% possible 1-month return on that XLV trade. So the TMC trade management calculator will be used for purposes of initial calculations and trade adjustments as well. As those of you who have this spreadsheet know that you have an opportunity to manage your trades as well with this spreadsheet. Here are the 3 packages. Now, the middle one is the one I've been talking about, the enhanced CEO package, which includes the TMC trade management calculator. And you get the 6 products that I talked to you about, the 2 new spreadsheets, the trade management calculator, its user guide, and the 2 books in PDF format. That's all, and that's a reduced price in itself because you're combining the basic CEO with the TMC. Now, I know that many of you already have the trade management calculator. So we have the basic CEO package without the TMC for $197. Now we have over here, you can combine the enhanced CEO package with our BCI package, our best and most comprehensive investment package. And that's where we add on to the 6 items in the CEO enhanced. We add on 6 online video courses, 6 calculators developed by BCI, 5 additional books in PDF format, and our 13-month annual premium members subscription. Some of you may want to move from monthly to annual. Now, once again, here's the enhanced package. I told you about the 2 books in PDF format, the 2 new spreadsheets, the trade management calculator, and its user guide. So that's the enhanced CEO package you see on the top. But if you have the TMC, you'll get the 2 spreadsheets and the PDF of the book for $197 before the discount, or combine it with the BCI package, which again are these online courses, calculators, 5 additional books, and an annual premium member subscription. And that's at $1249, less the 15%. Ladies and gentlemen, that ends our presentation for the CEO strategy. I want to check in with Barry to see if there are any questions outstanding. Barry, can you get on?
Hi, can you hear me okay?
Yeah, just talk a little bit louder.
Okay, there were 3, actually 4 that came in as private emails, private chat questions to me, not to the entire user base. First question is, can we use this strategy with all the exit strategies that you showed in your last book?
Okay, so can we use the CEO strategy with the 14 exit strategies from my last book? The answer is, of course, yes, definitely you can, but that would detract somewhat from our goal of making it a little more time efficient and user friendly. So you can craft this strategy to whatever your specific needs are. So yes, feel free, master those 14 strategies, learn them, and then say, you know what, in Alan's book, he used 4, I'm going to add these 2, or I'm going to stick with the 4, or I'm going to do all 14. So it really can be crafted to whatever your specific needs are. No one approach is right for every investor.
Okay, let me scroll a little bit more. Can we use this strategy if we have $10,000 to invest?
Okay, $10,000 is going to inhibit our diversification requirement. I would say if we had 4 positions, a minimum would be 10,000 per position. I would say 40,000 would be what you would need to implement this strategy and be properly diversified. Now, for those of our members that want to build up cash to then begin trading options, I would suggest my 4th book, Stock Investing for Students, which is a way of building up portfolio wealth using broad market, low expense ratio mutual funds in a very user-friendly way. And that book, by the way, is being used in 4 universities here in the United States in their financial literacy program. So it's not options, but it's a way of building up portfolio wealth, mainly using index funds. But I would say, to answer the question, figure 40,000 would be your minimum starting point for the CEO strategy.
Okay, the next question that just came in before I scroll down to the ones I haven't gotten to yet is, what if we have 40K between 2 different accounts, 28K in one IRA and 11K in another IRA, or almost 40K in total?
Well, yeah, I mean, yes, you could do, I mean, it would be simpler if you could put it all into one account, probably be a little more time efficient if that can be done. But if not, and you're using this strategy in 2 accounts and maybe have 3 securities in one and 1 in the other, I would say, yes, it's doable.
Okay, next question is, can we get higher returns using weekly options?
Weekly options. The short answer is probably yes, because the shorter term options will usually result in higher annualized returns. The caveat here is, of course, that this is a streamlined approach and time efficient. And when you're doing weeklies, you're changing your portfolios 52 times a year as opposed to 12 times a year. So once again, if this meets your specific needs and your specific lifestyle, and you like the idea of using select sector spiders, you like the idea of reducing your securities from 8,000 to 11, and you want to use weeklies, absolutely yes, you can do it. And chances are you're gonna definitely put yourself in a position and an opportunity to beat the market consistently, and probably with a little bit higher returns than if you use monthly. So yes.
Okay, a couple more questions. They're still rolling in. Can this strategy be combined with puts?
Yes, it can. I'm looking for a time when I'm going to say no to somebody here. Oh, I said no to 10,000. Um, uh, yes, you can. You can enter your covered call trades by first selling out of the money cash secured puts. For those of you who have been members of BCI for a while, you're probably familiar with our PCP or put call put strategy, also known as the wheel strategy outside the BCI community. And you can sell an out of the money cash secured put to then enter a covered call trade. Or, you could just use the select sector spiders for your selling, for your put selling. So yeah, it could be crafted in a myriad of ways. So my hope is when I write a book like this or any of my books is that each investor can take the material that they learn from the book and then tweak it if they want to meet their particular trading style and personal risk tolerance. When I started doing this back in the 90s, it was like this strategy is one size fits all. You can only use it in flat markets. You can only sell out of the money calls. There's no exit strat. I mean, there's so many ways to craft these strategies to meet our needs and to adjust our trades that there's just no one approach that's right for everybody. Our goal at BCI is to provide the information to help investors select the strategy approach that's best for them, and this is one such example.
Next question. In your covered call book, you put together a detailed approach for selecting stocks leveraging IBD and other technical indicators. What analysis replaces this for the spiders?
Well, the analysis that I used, and it is shown graphically in the book, is simply price performance over the last 1 month. So the best performing select sector spiders over the last month. Now, for premium members that study our weekly reports, the ETF report, which will be publishing Wednesday, a new one. We also require them to beat the S&P over the last 3 month time frame as well. So if you're using our ETF reports, then you'll have those select sector spiders that not only beat the market over the last 1 month, but also over the last 3 months. But what I used in the book in this streamlined approach is the best performers over the last 1 month. Now, keep in mind that we're dealing with the S&P 500. So we're dealing with the best performing large cap blue chip companies that trade on the US exchanges. So, and they're exchange traded funds. So we don't do fundamental analysis. It's basically just technical and really just price performance.
Okay, two questions are relative to the book. First one is, per having a printed book, what will it cost with a printed book? And the second question is, if we buy the PDF book, do we also get a printed copy when it's available at no cost?
Okay. Actually, the price of the book, I believe, is going to be, you think, I believe on Amazon, it's going to be 39, and our website, it'll be 37. Um, the cost of the book, because of the 199 color, is pretty high. But I felt that that would be helpful in terms of seeing all the charts, the graphs, the screenshots from the brokerage account. Now, the printed, I do have several hundred copies of the printed version. So for those that order the enhanced package, what I'm going to do just for our premium members is, if you send me an email that you'd like a copy of the printed book for this week only, for the enhanced package or the total package, I'll send you a complimentary copy of the physical book. How's that?
Okay, sounds like a good deal to me. Next question. What if
Hold
the
on, I'm gonna-
spider doesn't have at least 100 contracts in open interest at the selected strike?
Um, if it doesn't, it'll come darn close because these are near the money strikes and the select sector spiders um, are very popular. It was not a problem over the course of trading for the year. But remember, there's also our guideline is not only 100 contracts of open interest, but I add to that and/or a bid-ask spread of 30 cents or less. So I think it's gonna be very difficult to find a situation when you're not getting that with the near the money 1 month expiration strikes for this strategy. It never came up
Yeah.
in a year of trading this. I'm not saying it never will come up, but I could tell you that it never came up for me in the last year. It's a good question, but
Uh,
not a concern with these securities.
and we might add to that, there's also the opportunity to do a bid-ask negotiation with the market maker on top of that.
That is true. Those of you who know that I have published articles, it's in my videos, how to negotiate with the market makers. Give you a quick example. It's based on what's known as the show or fill rule, which is an SEC rule made for us retail investors. And what it says is that if we put in a limit order that improves the market, which just means somewhere between the bid and the ask, that the market maker must do one of two things: either execute the trade at that limit order or publish it. So let me make up a quick example. Let's say the bid is $2.50 and the ask is $3. Now, most of you know that the market makers benefit from a wide spread because the difference between the spread is what they put in their pockets and buy the next yacht. So they want to keep the spread as wide as possible. So here's what we can do. We find the midpoint called the mark of the bid-ask spread. In this case, $2.50 to $3, that would be $2.75. Then we put in a limit order to sell to open, slightly favoring the market maker. So instead of 275, the midpoint, we put in 270. Now the market maker must make a decision. Am I going to give Alan his 3 contracts at 270 and keep the spread $2.50 to $3? Or am I not going to give it to him and then have to change the published bid ask to 250 to 270? So they're kind of in a position where frequently we will get that better price. Instead of 250, we'll get 270. Worst case scenario, you get the published bid, but frequently, and I've been doing this for decades now, frequently you will get the better price.
Okay, next question. What are the 4 exit strategies that are used in the new CEO approach?
The 4 exit strategies are rolling down and keeping the stock, rolling down and selling the stock, hitting a double and keeping the stock, and hitting a double and selling the stock. Very simple. And you always must have your 20%, 10% guidelines in place. And you must put a note in your calendar or however you do it to change that 20% buy to close limit order to 10% the weekend before the last 2 weeks of a monthly contract. I actually show a screenshot of that in the book. And by the way, just so I can admit to you guys now before I'm found out about this, I did make 2 or 3 mistakes over the course of the year of trading. Only one hurt me a little bit, so my results could have been higher by a couple of $100 when it was something like this. I don't remember exactly what it was, but it was something like I bought 400 shares, but only sold 3 contracts. And then I realized it when I was writing the book. So, and then the other 2 were, I forgot to put in the, change it to 10% or something like that. But I owned up to it. I put in the book, my mistake, I made a mistake. So 2 or 3 times in the book, you'll see minor errors that I made. we're all human and we're all going to make mistakes. And just as long as, we don't make them over and over again, all is good. So those are the four exit strategies.
Okay, next question. I usually have 5 to 6 positions with equal cash. Can I simply replace one of those positions with one of these spiders and as a way to diversify, or does it really need 4 CEO type positions?
Well, it depends on what strategy you're using. So if you want to use a streamlined strategy, um, then I would think you wouldn't want to go up to 7 securities, but you can. And if you're going to use individual stocks, then your expectation and initial time value probably be higher than 1 to 2%. It's kind of like, are you mixing strategies? I'm not really sure. Are you using only ETFs? Are you using stocks in ETFs? Um, so yeah, you could use, I mean, look, I have multiple portfolios for my options trading. And, some of them involve ETFs, some of them involve calls, some of them involve puts, some of them involve weeklies, most involve monthlies. So, I find it easier to manage my portfolios when all of them are a similar approach to option trading. But, if you want to mix and match, you certainly can do that.
Okay, next question. Will you be using any dividend ETFs?
Well, that's a good question. I think some of these ETFs do offer dividends, but I wouldn't base my selection on a dividend. I look at a dividend as icing on the cake. I base my security on the price performance. When I'm doing stocks, also fundamental analysis, common sense principles, but not on the dividend. Now, I know a lot of you like to also capture a dividend, and I've written about this multiple times, how to do an approach to a three-pronged uh, income stream where you get option premium, share appreciation from out of the money calls, and then dividend income. And we talked about how to avoid ex-dividend dates and, you know, uh, using weekly sometimes, or, waiting for the ex-dividend date and then writing the call. So I've written about this, but I would not recommend making a decision on which underlying to use based on the dividend or lack thereof, but rather on the price performance and the initial time value return.
Okay, next question. In this approach, are in the money strikes off the table?
No, in the money strikes are not off the table. Um, if we are in a confirmed bear market, I could have used them in 2022 for sure, and a year like 2008 for sure. Actually, in 2008, we could have used inverse ETFs and made a boatload of money, but who knew? But yes, you can use in the money strikes, as long as I mention it in the book. You can use it, but the blueprint that I used for this book, and addressing this strategy and introducing it to you was all out of the money. But you can definitely use in the money strikes. The one caveat is that it must achieve our initial time value return goal range. In the book, I used 1 to 2%, which I think is a very reasonable range to use for this strategy approach.
Okay, next question. So Alan, you rode the bear market in 2022 with this approach going long with spiders, with the highest 1 month relative strength. It was question mark at the end, so I'm guessing, is he asking, was that the approach?
The approach was to each month to take a look at the best performing select sector spiders over the last 1 month. I would look for the four best. Now, if number four and number five were very close in price performance, that happened a few times during the year, then I would use 5 securities. So let's say one was up 1.1% and another was 1.12%, another was up 1.15%. I'd use both of them. So then I would have 46% approximately of the top performing stocks in the S&P 500. So I based it solely on 1 month price performance. And I did only use out of the money calls, but you certainly can use in the money calls, or you can mix and match like we do with traditional covered call writing. With the premium stock reports that we put out, the market tone on weekends, I always, at the beginning of a contract will say, my plan is to favor out of the money 2 to 1 over in the money. And I let you know what my thinking is. Doesn't mean you should do the same thing. I mean, you may disagree with me or you may agree with me, but you don't have to do all of one or all of the other. But in doing a book where I'm trying to get a certain blueprint strategy across to, I don't know, probably end up tens of thousands of people, I wanted to keep it as simple, as straightforward as I could. So I used the out of the money, near the money strikes that generated 1 to 2% on the best performing 4 or 5 select sector spiders.
Okay, next question. Curiosity question, it's labeled as, when playing the bid-ask spread, are they usually analyzed by software, not a real person? I'm assuming that's the question, human or not human. There are thousands of option contracts per day. One can't expect market makers to handle them all, especially with
Well,
small transactions.
yeah, I would say there's an algorithm for that. And they probably factor in how many contracts, what's the spread, they probably have an algorithm for that. Quick story. Um, my son was an attorney for the New York Stock Exchange, and he got me a tour of the floor of the New York Stock Exchange by what they call the governor. That's the guy that makes all the decisions if a stock is going to be halted and that kind of thing. He gave me a personal tour, and we were talking, and I was noticing from the corner of my eye that there was a market maker standing there that had like these 7 or 8 screens high up in his booth, and a table, and on the table was this gigantic salad. And he was, I'm speaking to this group of people for about 5 or 10 minutes, and for that entire time, all he was doing was eating his salad. So I said, I said to the governor, "Excuse me a second." I walked over to him, and I said to him, "I noticed here you're not even looking at your screens." So he said to me, "Oh, no, no, no." He says, "I don't have to look at my screens." He goes, "Our algorithms do all the work." So there you have it. He was there physically, but the most important thing to him at that point in time is getting through that big salad. So I would say, to answer your question, more than likely it is an algorithm. I think you're right about that, and they'll base it on factors like how many contracts and what the spread is. The fact that I'm just going slightly below the mark or midpoint, I think that gives us a good chance to get our trades at a favorable price.
Yeah, just from my own personal experience in doing this since about 2008, 2009, I almost always get a decent negotiated premium. Sometimes I have to leave the trade open for 15, 20 minutes, sometimes a half a morning, but most of the time I get my target premium.
Oh,
So
that's terrific. The one caveat with that is that 15, 20 minutes, I might be a little concerned about the price of the stock changing. Um, maybe not getting quite the premium that I anticipated. But if you're getting it uh, consistently, maybe that's something that some members want to take a look at.
yeah. Next question. Do you have any examples outside the book of inverse ETFs as part of a mixed strategy?
I've been writing articles now for 16 years, and I'm not sure if I wrote one on inverse ETFs. I think I did, but I'll tell you the best way to find out. If you go to our website, you'll notice that there's a Google search tool right at the top of the page. All you have to do is type in inverse ETF, and I'm willing to bet that you're going to find probably a couple of articles on it. So check it out.
Okay, next question. They're still rolling in. I'm an annual member and have the TMC. I purchased the basic CEO package. Will I need to purchase a hard copy since I don't need the elite package? Thanks for your effort in putting this together.
Oh, hey, Barry, could you repeat that? I missed what he has.
He's an annual member and he has the TMC package. He purchased the basic CEO package. Will he need to purchase a hard copy since he didn't need the elite package?
Oh, no, tell him to send me an email and I'll take care of him.
Okay,
Or
Frank,
you. Yeah.
Frank, please send an email to me or Alan, and we'll get you squared away. Next question: is there a dedicated weekly, monthly report for users for this approach?
Well, every week we put a in our ETF report, we have a section for the select sector spiders. So sometimes there's 3, sometimes there's 4, sometimes there's 5, but so every week that is updated. And you'll get, as I said, with our ETF reports, not only the ones that have outperformed in the last 1 month, but also the ones that have outperformed in the last 3 months. And you'll be getting a lot of other information as well, implied volatility, things of that nature. So yes, in our premium reports, we do update that, the select sector spiders. Now that's in general, not specific for this strategy, but those are the ones you'd want to use for this strategy.
Now,
And in
along
the
with that,
book, I also give you a couple of other ways to access that kind of information.
now, another question relative to the one you just answered is in the BCI ETF report. Sometimes you only have 3 ETFs and you require 4 ETFs for the strategy.
Yes, sometimes, especially in a declining market, it's very difficult to find select sector spiders that have beaten the market in both 1 and 3 month timeframes. So there might only be 3. I can remember a couple of times over the last dozen years when there were only 2. So in the book, I give you other ways of finding stocks that have select sector spiders that have outperformed in the last 1 month without the 3 month requirement.
Okay. Next question: would you be comfortable with this strategy with a large account, $1 million plus?
Well, I believe if you have $1 million account, we have many members that are trading million or more. Never to put all your eggs in one basket. So I think that somebody who's just starting out to use it, which is probably everybody since this is the first time we've introduced it, is to start out, smaller, keep doing what you're doing, and then you'll make a decision as to whether or not you want to put more of your money into this approach or leave it the way it is or less money. I would kind of dip my toes into the pool before I jumped into the Pacific Ocean. But I think in general, I would think that if your goal is to streamline and make it more time efficient, you're willing to accept, slightly lower returns than traditional. I would think that ultimately, yes, you could do something like this with larger accounts as well.
Okay, next question: how do you determine the spider fund if it changes weekly? I'm not sure I understand the question. How do you determine the spider if change weekly? I'm not sure what the person is asking here.
Maybe he's asking if we do weeklies.
Yeah, or how to determine the
Why don't that
appropriate
person
spider.
type in the question over again?
Yeah, yeah, or send it to me via email and we'll get that squared away.
Yeah,
Um, does it make sense to do covered calls in a margin account?
I I don't believe I don't like to say 100% anything, but I believe that most retail investors should not be trading on margin. Now, I get a lot of people that don't like when I say that, but maybe it just comes from my roots, having grown up with not much, and I just don't like the idea of borrowing for trading. Uh, so I would say that for very sophisticated, experienced investors, maybe, but for most retail investors, a very high majority of retail investors, I don't believe it's appropriate. Sorry, guys.
Okay, next, I think this is the last question. Alan, I have the book, and if I'm a premium member, do I already have the calculator? Then what else do I need?
You have the book? How can he have the book? I haven't.
Yeah.
Maybe he
So,
means the TMC, the exit strategy book.
yeah, this gentleman doesn't, well, I assume it's a gentleman. He doesn't say exactly what he's got. Um, okay, yeah, it's gentleman. Brad, if you send us an email, we'll get it squared away. Yeah, he said
Okay.
he just responded, that's what I mean, but I'm still a little confused, but
Okay, Brad, just send Barry or me, send Barry an email. Let him know specifically what you want. We'll get you all squared away, promise.
okay, next question. Alan, two questions as a purchaser of the DMC and the premium member. One, when I emailed you, you said since I bought into these two, I don't have to pay more for the enhanced and updated covered call writing online program. Where can I find it?
Okay, so anybody that purchased the older covered call writing online video course, when you log in, you're going to just automatically get the new one. You don't have to pay any additional. Just use the same login information you use for the older version, and you'll automatically get the newer version.
Okay, and Corey also writes, can you please send me a hard copy of the book? And I'm not sure which book you're referring to, Corey. And he's also saying he's not seeing it. Can I send an email with a screenshot? Yeah. Why don't you email us? Outside of this session, and we'll get you squared away.
Okay, I always want to make sure I take good care of my premium members. Over the years, most of you know that my first career, I was a dentist, and I just became very fortunate to be able to have a second career that I also love very much. And I just want to say to you, the premium members, that without you, me and Barry and our team would just be a couple of guys with some ideas. But you guys put us on the financial map big time. And it's a very humbling experience for us. Every day we shake our heads. We can't believe the feedback, the testimonials. I get calls from institutional investors asking me my opinions on covered call writing and put selling trades. I recently had a very well regarded institutional vendor asking me how to calculate a particular trade. That just shows that you guys have really put us on the financial map, something that we never dreamed would happen to this extent. So in conclusion, I just want to thank all of you for being premium members, for supporting BCI, and for attending this webinar presentation. Keep sending us your ideas. I mean, maybe you like this idea of these premium member sessions, only for premium members, some ideas of what you'd like to hear us talk about, and, we'll certainly take your ideas into consideration. So Barry, thanks for helping out today. Thanks to all of you for attending. And as always, ladies and gentlemen, this is Alan Ellman and Barry Bergman. Take care, everybody.
Okay, one last thing.
Yep.
Daniela and Brad, send me an email with your question so we can get you squared away.